backup water and good fiber. If you don't have those offerings to a tenant, it's almost like trying to rent a hotel room without a bed and without a shower.
Today I'm talking to Stephen Brown, who is one of the more well-known CEOs in the country. He's the CEO of Fortress Real Estate, which again is one of the largest funds in the country. Effectively, the big news in the early sort of 2000s was diversified fund. Now we're seeing this sort of push to a focused fund. How do you now deal with the rest of the assets?
I think focus is critical. So we want to focus on logistics, and we've also got rural retail. Those are our two key areas.
To go back to Standard Bank, and I know a lot of the guys from Standard Bank, and it seems to attract like a really high caliber of team member in the corporate finance space.
Banking gives you such insight into finance and into a lot of the client portfolios.
Tell me about the industry and what you think, all your stakeholders, right? And when I say stakeholders, I'm talking about the brokers, property management. What do you think needs to change?
The property management space, I believe, is going to be primarily driven by technology.
Welcome to the Corner Office, where we bring you the latest news from the world of commercial real estate, the greatest voices in the industry, and the corporate chats you've been missing. Let's get to it.
Today I'm talking to Stephen Brown, who is one of the more well-known CEOs in the country. He's the CEO of Fortress Real Estate, which again is one of the largest funds in the country. He's gone through an amazingly difficult period of his leadership. We've transitioned through COVID-19, which was a pandemic which rocked the world and really had a devastating impact on property funds throughout the world. He's led Fortress through this change successfully, come out the other end, and is implementing and growing this fund to new heights. Stephen is a CA from UCT, also attended Sicilian's College in Johannesburg, and it's going to be fantastic to have him on today, just talking about the fund, talking about his thoughts on leadership, and talking about where he sees innovation in the real estate space going forward. Steve, you have one of the more coveted positions in the industry, although probably not 3 years ago. That was probably the least coveted position in the industry. But Fortress's growth has been great this year. It's a great business. It's got a good direction. But just running back a little bit, I mean, take me 5 years back and then take me through the last 3 years, which has been like a really challenging period. Just as a leader, not necessarily even as a real estate leader, but just as a leader, looking at the business and sort of how you've had to sort of navigate there, because you're a listed business, which means you've got a number of really big shareholders, influential ones. You've also got your employees, and then you've got your market perception, and then you've got all your stakeholders. It's quite hard to pull that all together. I remember playing golf with you probably 2 years ago, and you were like, guys, just lease some properties, let's get these deals done, and you've managed to get through the whole thing, and now we're sitting in such a great position. So run me back through that.
Yeah, it has been, I think if I look back over the last 6 years now, it was really 2018 when there was a lot of noise around Fortress, around Resilient, Nepi, all of those companies, which stemmed from a similar management team and a similar sort of nexus. And that was really tough, and we had to split the businesses, and we took Fortress, we moved offices, and we really crafted a whole new strategy in 2018 with Fortress, and then I officially took over from Mark in 2019. It has been tough, but we did some calculations, and I think what's quite interesting is so from 2019 to now, I took over from Mark. I think it was announced end of 2018 and officially mid-2019. Our net asset value per share has actually gone up over those 5 years, which I think is quite amazing considering we went through COVID. We lost a lot of value in that period on the listed shares that we held. But what we really sat down and thought hard about back then was just the simplification of the business. We had shares in Lighthouse, shares in Resilience, shares in Nepi, still quite a lot of offices, and we really needed to just make it simpler. So we got rid of the Lighthouse shares, we got rid of the Resilience shares, and we stuck to Nepi because we were the largest shareholder. We had 25%, and that's really been a powerful business, and one of the primary sort of bastions of the Fortress is our 14 billion rand shareholding in Nepi. So I think that's been an interesting journey. But the challenge, as you referred, in the last 3 years was really brought about by the dual share structure, which is something I inherited.
Yes, yeah.
I didn't put it together, but we had to try and fix it, and it was really.
So to my mind, I mean, just going from like a layman's perspective, you've got the way the Fortress is set up is you've got A, B shares, you've got effectively debt, just like any other REIT would have or any other listed fund would have. You've got your debt. Then you've got these A shares, which are effectively, the way that I see them, they're almost also debt, except they just increase every year. The debt almost just goes up and up and up and up by an amount. So it's kind of a terrible thing. However, it can be a great thing because it's cheap in a good market. That's kind of how it looks to me from an outsider's perspective. What changed? What goes wrong?
I think you're right, and the market changes. So you can view them as additional debt, which adds gearing to the B shares, and that's how they started out as debentures in a property loan stock structure. And then it boosts the returns, and the A shares chugged along. I think they were listed at about 10 Rand and got to probably a peak of about 20, 21 Rand in 2019, I think. And the B shares listed in 2009 at 1 Rand and got to a peak of 42 Rand. They were the best performing stock on the JSE.
Incredible.
I think, top 3 for 3 years, and at one stage at the top performing share over the 5-year period. The Sunday Times runs that whole top companies thing. So it works when there's a bull market. The problem is when things change, and that's where the devil's in the details. So it started out as debt, but we converted to a REIT, and those are then equity shares, which relies on, firstly, the words in the MOI and what that contract says, and then also on the board declaring a dividend. So it's not cumulative. And I think that change and the change in the market really forced us
relook
and unwind it, and let's get simple. And simple structures are usually robust ones. So that was really what happened. And I think had it been a bull market for the last 10 years, we may still be sitting with the AB structure and probably 2 classes of happy shareholders. But it was the market downturn that really caused some issues.
And probably the ratio between the two. I mean, the B starting at 1 and the E starting at, I think it was 10. I don't know, 10, yeah. Ultimately means that you've got a big number here that you've got to continue to keep feeding. But anyway, nonetheless, it was, now you've collapsed it, and you've got a situation where you've got a much cleaner fund. Everyone likes it. Everyone likes the simplification of it. You've also come out of effectively the big news in the early sort of 2000s was a diversified fund. Now we're seeing this sort of push to a focused fund, where you have an Equites or logistics fund, or you have Spear, which says Cape Town only, and you have all of these different funds. And now you've got this diversified fund, which you're pushing more and more and more into this logistics fund. So you're just growing this logistics space. How do you now deal with the rest of the assets? I'd say to you, let's do a deal. We'll take these offices, we'll put them in another entity, and you just go and do the best office fund in the country. You just put them somewhere else. I think it was years ago. It was at one of those REIT conferences, and the guys from Storage said, if you're going to do something, just be the best at that. You can be the best B grade office fund. Just be the best at that. And there are a couple of those in the country. And how do you get that right? I mean, you've got to try and achieve value for these things because they're obviously sitting on your balance sheet at a value. Or are they? You know what I mean? It's like a NASBAS. They sit there and they say, well, these assets, we see it pretty much nothing, and we just value the 10-cent thing. So it's
we have a similar problem. With if you take our market cap of roughly 18 billion, you deduct our 4 billion of NEPI shares, you get 4 billion. And you look at our NAV, and that's 16. Now, is 4 billion less than or more than 16? Well, it's quite a lot less. So, and we're selling assets at actually above our book value. So we keep proving that the 16 billion is real.
But no one wants to see it.
But no one wants to see it. And I think, we had a strategy session a little while ago, and I pulled up some nice stats from NAREIT. And from 2016, they've got the performance of each subsector in their listed REIT world. And I think it's telecoms and data centers and industrial that are leading the way. And right down at the bottom, and one of the only negative ones, are the diversified REITs. Now, you would think mathematically the diversified ones should sit somewhere in the middle of the pack because they've got a bit of everything. But they sit right down there at the bottom. And that's because they don't have focus. So I think focus is critical. So we want to focus on logistics, and we've also got rural retail. Those are our 2 key areas. Could, in the future, we split those? yes, I think that would make sense. But the storage guys are absolutely right. And your comment on be the best B-grade office fund you can be, I still think you're going to have more value add out of getting specialists, even if there are headwinds in that particular subsector, than having them part of a big diversified fund with no management focus. Yeah. You know, our offices, fortunately, on that side are quite small. I think by the end of the month, which is the end of our financial year, probably be under 2% of our total assets. So it's relatively small. Yes, we want to realize value, but there does come a point in time where you just want to cut that tail off and move on with your strategy.
So again, it's just simplification because people can't see these different things. Yeah. What do you do with these NEPI shares? Do you sell them? Do you buy back? I mean, clearly the Fortress kind of picture is hugely discounted. So do you go and buy back Fortress to say, well, let's shift those? People are not seeing the value in it, or do you? Yeah. Do you settle debt? Do you just hold on to the NEPI shares? I mean, it's such a big number of your whole balance sheet now, Yeah. Well, not necessarily, but that's what the market says.
Yeah, it's 14 billion of assets out of close on 50.
Yeah, because that's what you could sell it for. I mean, it's traded. It's like
100%.
Instant. It's like cash. Yeah.
So I think, we faced a similar dilemma when we had our Resilient shares. We had about 13% of Resilient, and it was the share price was down and undervalued in our view. So we gave that to shareholders. We unbundled it actually in March 2020, just before COVID. And I think that's probably at this share price something that we would tend to prefer over selling it. NEPI is giving you on a dividend yield and at a 90% payout, an 8.5% dividend in euros, 31% LTV, 7 billion euro portfolio. It is just, and it trades probably 300 million rand on the JSE every day, so it's extremely liquid. Now, I think that's a great investment. Does it make sense in our longer term future to hold it? I'm not so sure. But at this share price, I would rather, if you were a shareholder, say, well, you've got this through us. It's probably causing a bit of a discount and a dislocation in the market. Let's give that share to you, and you can decide whether to sell it.
So you actually give the NEPI share back to your shareholders?
Well, we could, and we've done that with the Resilience before. I think the fortunate result of all of this and not being a REIT is it does make these unbundlings in a vanilla corporate structure that's not a REIT a little bit easier to do. So that is something that we could do to unlock it. Naspers and Prosus, they've gone down the route of selling. I think they're selling Tencent and buying shares back, and that does make a lot of sense. We could do the same. Buybacks have always got to be on the table, but with the one caveat on, is it executable? Naspers is such a big company. It's got, I think, over R1 trillion, maybe a R2 trillion market cap. Our shares are not that liquid. So I think the executability of that in a quantum that makes a lot of sense is maybe something that we need to consider.
Interesting. I mean, the numbers are significant, and for such a long time, I remember all of the real estate, all the REITs were sitting at the top, of market caps. I mean, they were significant market caps, so they kind of moved the market a lot. So, an interesting statement. To go back to Standard Bank, and I know a lot of the guys from Standard Bank, and it seems to attract like a really high caliber of, team member in the corporate finance space. A lot of the guys just come out with a lot of credibility, and they go into all of these different places in the industry, as it were. Tell us about Standard Bank. It's quite Investec's quite open. They got their lounge, and all of the guys there, and it's a great vibe. Standard Bank, in my opinion, is probably a little bit closed set. However, maybe as a CEO of a listed fund, it's a little bit less closed set. Maybe that's who they're targeting, and not getting to know John Jack.
Look, I think it's the nature of the size of that bank. It's It is maybe a bit more stayed in their culture. It's a lot bigger than Investec. I think those are probably the two outliers in terms of our big banks in terms of culture. Yeah. I was there for, I think, about 4 years, 2009 till 2013 when I went to Fortress. So I wasn't there for that long, but it was a great experience. I think banking gives you such insight into finance and into a lot of the client portfolio. So I think in terms of oversight and detailed non-public oversight, it's probably a great place to learn. I was very fortunate there. they had this mentorship program, which obviously being Standard Bank, it had to be formalized and structured. Yeah. And my mentor was a guy by the name of Stuart Shaw-Taylor, who was very influential in the listed property space and in property finance. And he was a great guy to learn from. Very much, he had a great balance of the high level, but also in the detail. And it was something that I learned from him. When you used to take him any kind of paper, whether an equity paper or an idea or a debt paper, he was always the one guy who would tell you what's not there. In other words, what are you missing? I think it's very easy for people to assess what you're saying and to be critical or supportive of your particular statements, but it takes a unique insight when someone says, did you think about this, which maybe you haven't thought about, or this is missing from your analysis. And that was one thing that I learned from him. He's, I think, in his mid to late 70s now, but he's still around, and I see him and have coffee with him every now and then. Interesting.
Yeah, I remember that name well from sort of early 2000s. He was a significant player in the industry. There were a couple of guys, and I mean this whole REIT industry really, it was pretty much early 2000s. You had the growth points spinning up. You had, was it Spear, and all of those businesses starting to spin up. And we were talking about Pangborn, then got acquired by Capital, and Capital became Fortress, and there was a lot of activity around that time and a lot of fun. I mean, properties were just doubling in value basically overnight. It feels like industrial's doing that a little bit at the moment. I mean, if we roll back just pre-COVID, 2019, you get a brand new proposal for a new DC, 62 Rand net, okay, 10-year lease, big corporate client. Today you can't get that for 95, And this is in like a 3 or 4 year period where suddenly it's gone from 62 Rand, and it had been tracking up marginally for years. It was 55, 56, 62, and suddenly we're at 95, 100, 105. Well, you've suddenly got these. Obviously the jump in steel prices had a significant impact. You don't really have a lot of GDP growth in South Africa. You've got a massively increasing interest rate cycle, but then on top of that, the steel price increases 50%, and we're getting these deals away. Yeah, it's unbelievable, to go and look at, to say, from you're saying, okay, these things are, and what's nice is you've got this whole portfolio, and the rest of the portfolio gets pulled up into the new space. But the new deals that you do are at similar yields to what you were doing yields at, 3-4 years ago, relatively, but the rentals are 50% up. So it's just a fascinating space to be in. Are you seeing that tail portfolio is now just getting completely pulled up into these higher pioneering rental levels?
Yeah, I think we are. And what we're seeing is 3 years ago, we were getting these contractual escalations, which is still an oddity and unique in South Africa. Yeah. And that was leading then on expiry of those longer term leases, 10 years, to huge reversions. We're now seeing a lot less of that. Guys are expiring who maybe started out at 59, 60 Rand in Loladia 5 years ago, and they've escalated to 75 to 80, and we're managing to renew them at that same expiry rental, which I think we almost didn't expect a few years ago. And you're right, it's really driven by the construction cost. As you said correctly, the downside is we're still developing things at 8.5 or 9%, but that is 85 to 100 Rand. I mean, we're signing deals now in Clearwood well north of 100 Rand a square meter net. It's crazy. And our offices are sitting at 85 gross. Yeah.
And I remember when you bought Clearwood, it was sort of 400 million Rand odd, I remember, and everyone, it's ridiculous price to pay for land, and there was a lot of stigma around that property. And then there was, of course, the EIA, and you had to sit, and it was probably about a good 3 or 4 years, from what I can recall. And all of a sudden, you've got this seriously popular top logistics park achieving these kind of rentals, and now you look really smart, but it's that long-term vision, I think. You've got to. Real estate's one of those assets you've really got to have long-term vision.
You do. On that one, we've impaired at 1.2 billion. So, was it worth 400 million at the start? I don't know. Yeah. But interesting, and this is why property and time and a bit of inflation is such. It makes it such a great asset class. We built the first building there. The cost was 364 million. I think we impaired it down to 320, and that led to this big initial impairment. Right now, although we feel like we spent too much on that, that building is now worth 400 million. So Clearwood, although we've impaired it down, and you could say, well, it was never worth 400 million, we should never have bought it. We've actually made real money. And I think because of the inflection of time and a bit of inflation, we have built this asset, and touch wood, we had the balance sheet to actually complete it. Because had we not, we might have really realized this gigantic loss. But it is a standout asset, and it was the EIA, it was the delays, and it was the damn hippo mud that's all around that area.
Yeah. I mean, you look at Natal now. I mean, it's you got tornadoes ripping through there. You had the riots not more than 3 years ago, whatever it was. You've had your service delivery there is a challenge, but you've got these pockets which are really good. You've got brickworks that the investor guys are busy developing. That's probably some of the last land, really high premium land that's available. So it's going to be interesting to see actually what happens in that market, because once that sort of dries up, where next? You can only go further north, I suppose, but
and I think the problem with KZN in particular is the brownfield sites don't really work because they are so well let and well tenanted with high rentals. So you can't go and pay 5,000 Rand, 6,000 Rand a square meter and break it down to build a new box. The feasibility doesn't work. So I agree with you. It is still Africa's largest port and busiest. So there's always going to
and now we see, of course, the announcement Traction put out. I mean, Traction are the Jamie Holly runs it as the CEO. They're the largest rail operator in Africa. So they run locomotives through Africa. For ages and ages and ages, they've been trying to get their locomotives into South Africa, but it's almost a monopoly with Transnet holding everyone off our rail network here. Now, recently they're saying we will see in the next year, we'll see private trains running on the Transnet network. What does that do? Suddenly we're going to be looking at, City Deep. Obviously started as a result of that was where the port was. Are we going to have different inland ports? Is it going to change the logistics nodes? Is it going to suddenly make this dream of, Cato Ridge and Hammersdale and that kind of thing actually work? It's going to be fascinating to see what happens when real rail operators, and I say real because I think Transnet, I remember years ago, probably 10, 15 years ago, looking at the list of, you get the top paid CEOs in the country, the Sunday Times list. You also get the top paid parastatal CEOs in the country. And it was Transnet from number 1 to number 100. You've got a good 15 people there getting paid over 10 million Rand a year. These are just radical numbers, over 10 people. And you think, okay, well, what are they doing? Well, they're running a monopoly, and then they ran the monopoly into the ground, and now you've got private guys coming in, and these private guys are just going to change the game. So that's going to be a fascinating space to watch, I think.
Yeah, I hope so. We do have a rail siding at Clearwood. I think it would be a game changer for the economy, and we would be a beneficiary of that. So, the more efficient the logistics, the better for everyone. I think, it's been quite sad to see the number of trucks on the N3 over the past 10 years. And you just know that environmentally that's bad. Efficiency-wise, that's bad.
Road deaths.
Exactly, everything. So I think we would be a huge supporter, and I guess hopeful and optimistic that Jamie and Traction get it right.
Yeah, it'll be interesting. Tell me about the industry and what you think in terms of all your stakeholders, right? And when I say stakeholders, I'm talking about the brokers, property management, even technology. I know you guys have had a foray into technology and you've built some of your own tech out in the business. What do you think needs to change? I think we're seeing these changes starting to happen. Technology is certainly a pervasive force in the industry if you look at it globally. What do you think needs to happen in the South African context? Do you think management is where it needs to be? Do you need better reporting? Do they need to have better understandings of the business? Do you see the asset management and property management function collapsing? Because there's a bit of overlap,
Sure.
Who am I going to speak to try and get this transaction done, What is property management and where does it go? What is broking and do you see an evolution of those businesses going into the next couple of years?
I think the technology, like every industry, it's going to have a profound effect. Real estate is probably the one that, because it is bricks and mortar, when dealing with physical space, it's pretty hard to digitize that.
Yeah.
And even when you try and digitize things, you end up with data centers. So even those tiny little electrons and bits of data need a place to live and to be housed, and that's in a data center, which ultimately has got a real estate play. So I think we're quite excited about the way it makes things more efficient. So in our business, we've built this ForTech platform. We couldn't find something that suited our needs, so we had to build it from scratch. And it just makes things efficient for the tenants, who can now see in real time what their electricity consumption is, what their water consumption is. And I think it gives them insight into how to make their business more efficient. And it's amazing when you see it in real time, how that makes you manage the demand better. So just by having that system, one tenant in Cape Town, they wanted to do a huge battery, and we started monitoring their consumption and giving them access to that. And they managed to bring their consumption down 40% by just turning they've got a temperature-controlled warehouse, by just turning the air conditioners on at different times and trying to manage their peak demand. So I think that's exciting. The property management space, I believe, is going to be primarily driven by technology, in terms of billing and in terms of tenant requests. So I think that'll be probably the biggest impact in our broader sector in terms of what's happening on the technology side. And I think that does make it more interesting for us, because the quicker we can get data and the quicker we can get information on what's happening on the properties, the better the decisions will be. So I think that will start to change things. And, then it's all the building tech, it's all the renewable energy, things like that I think is quite exciting to see change.
Yeah, because, my perspective on property management is you've almost had this fee squeeze over the years. So it was bigger and got smaller and smaller and smaller. And then that effectively changes your business behavior. So on the property management side, what they say is, well, we had one guy doing 200 tenants. Now we're going to have one guy doing 300, 400, 500, 600 tenants. And these people can only do so much, So then ultimately they get to a position where it just becomes far more mechanical. So it's not really thinking and engaging in that sort of human element, which is then pushed over to the asset managers. They need to think and engage and have that human element with the clients. And the property management becomes just a hugely administrative function. Get the rental in, get the lease out, communicate, just very, very quickly. So I agree with you. I think that why can't that be reduced to some format of technology or AI structure or whatever it is? I know there are dynamics in the negotiation of property, but you could probably make that pretty seamless. If you knew that you had one building that had 20 people come and view it, but you'd had not one offer, you probably know you've got a problem there. What is the problem? Is the problem the rental? Is the problem the look of the thing? What's the feedback? Or you've got one property that just has no one coming to view it. You've got another problem there, So I think that information can be shared far more quickly. And, I agree with you. I think you're going to see probably a leapfrog entrant into this market, where guys come in with a hyper-focused tech-type strategy. But take, for example, your portfolio. It's significant. Just the leases and the communications, the stage of deals. You've probably at any one stage got 100 transactions currently being negotiated, leases going out, deposits being paid. Now you want to shift that from one operator to another operator. That is just that just kind of gives you nightmares.
Yeah.
The ball's going to get dropped somewhere. And I suppose it's how much better will it be in terms of pricing and speed and information? Because those are the only reasons you change, right? If it was the same price, the same speed, and the same level of information, what's the point?
Yeah, I'll give you a comment on your business, and what I see the key driver of, you and how you've built this business to be so successful is its relationships. You guys are the guys who really hold those relationships together and have relationships with the tenants and build them with new tenants. Yeah. And we have the same thing. So when we looked at, our business and our key tenants, especially in the big logistics boxes, we had interposed a property manager who maybe wasn't as hyper-focused on that building that tenant relationship as we were. And I think in some cases distance fortress from our key tenants. So what we've done is on the big logistics boxes, about 31 of them, from the 1st of July, we're going to bring that property management function in-house. The property manager will still do some of the billing and some of the collections, but it's really purely a back office admin function, and we're going to bring some ops guys and property managers in-house so that we don't miss a heartbeat when it comes to reading what the tenant wants. Are they happy? Are they looking for more space? Are they looking for less space? And how can we help them out? So, I think it's those relationships that we're really looking to strengthen by insourcing some of the property management. I think that whole outsource model came from, property investors were these passive landlords, the lord of the land, and they would just put down their money and let the minions run around managing it.
And that made money at that stage. So great.
Sure, yeah. It's become completely different now. Now it's way more operational, even though we have these triple net leases. We get a lot of the bankers and new investors going, it's triple net. So, you sign it and you go see the tenant in 10 years' time. I mean, just believe me, it's not that passive. Even on the triple net leases, we're getting phone calls from the tenants almost daily on, what's happening with this, can we do that? So it's definitely not passive income.
I always use this building as an example. I mean, Fairvest, this building was a dog. I mean, it was this old Sasol building, had these like white jail type railings outside. Like it was really, it didn't look that welcoming, And to their credit, they've done an incredible job with the building. They've gone and put a motherland downstairs, which we were discussing earlier. They small things. They changed the color of the railings to black so you don't see them anymore. They changed the environment of the building. They made it a little bit more fun and friendly and funky. Suddenly the building's full, and that's taking like a well-positioned, okay, we are in Rosebank, but not a great actual fundamental building. I mean, the air conditioning is, we talk about it to them ad nauseum. You got these old, your electricity costs and all of these kind of things. However, it's now a fun building. There are great people here. It's a good environment. Fairvest actually downstairs, and you've got this coffee shop, and it's just things like those small things that suddenly turn the building on, and you are full. And if you're full and you don't have these vacancies, rock and roll, you're off to the races. Then you're getting the returns you want.
I think it's, tenants are always looking for a landlord that's engaging. And I think often what we liken it to, because this is the other end of the property spectrum, is a hotel. If you've got a well-managed hotel, you can be almost 100%, if not 100% occupied all the time. But if you mess that up, you can be 0% occupied the next day. Yeah. And, we have longer leases, but I think it's that mindset of making sure that what you're offering the tenant is suitable to their needs. We've got the load shedding. Hopefully it doesn't come back. It's been, 2 good months. But load shedding, backup water, and, good fiber. I think if you don't have those offerings to a tenant, it's almost like trying to rent a hotel room without a bed and without, a shower. It's still a room, but you can't really use it.
Can't use it, yeah.
So tenants, and I think that's where the whole game has shifted and where you need to be a more engaging landlord. What does your tenant need? Our retailers, they almost value the fiber more than anything because all of their point of sale systems work off the internet. If they don't have good fiber, they can't get revenue. They can't pay us rent. So, I think, as you were saying, Fairvest obviously an attentive landlord, and they're doing what the tenants want. It may not be the best building, and hopefully it's, for your benefit, priced correctly. But where you're listening to the tenant, you're engaging, I think that's where you're going to start to get, outsized returns and better occupancy rates.
Yeah, fascinating. Steve, it's been great chatting to you. I mean, often you find like in these scenarios, CEOs are maybe a little bit disconnected from what's actually happening in the business because you're dealing at a financial level, a share equity structure level. So it's great to chat to someone who actually has a deep understanding of what's happening with the underlying property assets and what's going on with the market and the stakeholders. And yeah, incredible and well done this year. It's looking really good, and we hope it carries on going in the same trajectory.
Well, thank you. A lot of it's thanks to you guys and your great brokerage team who sign all these nice leases for us. So thanks.
We try. We'll tell Justin Tom that. Lekker.